If you want to take your investing game to the next level, you need to know about long and short-term capital gains. What are they, how do they work, and how do you effectively use both to maximize your profits? And yes, as surprising as it may sound, you do want to learn how to use both if you want to maximize your profits. For those of you that are new to the channel, my name's Ben. I've made over 6 figures trading crypto. I'm on a journey to 10K a month of passive income, and I want you to join me on this journey. Let's go. The concept behind long and short-term capital gains is simple to learn but difficult to master. When you sell an investment for more than what you bought it for, whether it's stocks, bonds, real estate, jewelry, NFTs, or crypto, then the profit that you made after selling that investment is called a capital gain. Now, capital gains fall into 2 categories, long-term and short-term. Short-term capital gains are investments that you hold onto for less than 1 year before selling them for a profit. And long-term capital gains are when you hold onto your investment for 1 year or more before reselling it. It's pretty simple and straightforward, but the key differences between these 2 types of capital gains is how they're taxed. The tax rate on your capital gains are broken down into different brackets depending on whether it's a long-term or short-term capital gain, what your annual income for that tax year is, and what your filing status is. We're going to go over these brackets to see how your tax rates are effective. For the purpose of this video, I'm going to be using the tax brackets from the 2022 tax year, but the thresholds for these brackets do change every year. So if you're watching this video in the future, be sure to check out the tax thresholds for that tax year. If we look, we can see that the long-term capital gains are broken down into 3 tax brackets based on income: 0%, 15%, and 20%. Meanwhile, short-term capital gains are broken down into 7 different tax brackets that range from 10% to 37%. Both brackets also have different thresholds depending on which of the 4 filing statuses you file under. So for simplicity, we're just going to be talking about filing as single, shown on the top rows of both of these tax brackets that I got off from Investopedia.com. Now, to get started, one misconception I see a lot of people making is that they think if you fall into one tax bracket, then you have to pay that tax rate on all of your income. That's not true. We have a progressive tax system, which means no matter how much you make, you always start paying taxes from the lowest bracket up until the threshold amount. Once the amount after that is taxed based on the next tax year. For example, if I'm filing as single and I made $100,000 on long-term capital gains that year, then my first 41,645% would be tax-free because it falls into this tax bracket. And then the remaining $58,325 will be taxed at 15%. There are people who try to keep their profits lower because they think that they'll have to pay higher taxes on all of their income, but I cannot stress this enough. Now that we know this, we can start to go over the different capital gain tax brackets. For long-term capital gains, the first $41,675 is tax-free. After that, any capital gains ranging between $41,676 to $459,750 would be taxed at a 15% rate. And then all long-term capital gains after that number will be at a 20% rate. Now, if we look at the short-term capital gains, we can see that our first $10,275 is taxed at 10%, and from that amount up to $41,775 is taxed at 12%. We can already see a huge difference between how these 2 types of capital gains are taxed. Comparing the amounts from the 2 charts, the upper threshold for 12% on short-term capital gains is about the same as the upper threshold of the 0% bracket for long-term capital gains. So our short-term capital gains are being taxed at 12% before our long-term capital gains are being taxed. Then our short-term capital gains jump up to 22% from $41,776 to $89,075. This is already higher than any tax rates you'll have on long-term capital gains. After that, short-term capital gains up to $170,050 are taxed at 24%, and then after that, up to $215,950 are taxed at 32%, up to $539,900 are taxed at 35%. Anything over $539,900 is taxed at 37%. Whew, that was a lot of numbers. Looking over the tax brackets, it's clear that the United States government is trying to encourage investors to hold onto their investments rather than selling them right away. Just looking over the tax brackets alone, long-term capital gain taxes are almost always lower than the tax rates on short-term capital gains. There is weirdly a $100 exception to this in each filing status though, but this is an outlier and it's only a 3%. Your short-term capital gains are going to start being taxed at the 22% bracket. Long-term capital gains meanwhile fall under their own tax category, so you can take advantage of the lower tax rates that are there. On paper, it seems like the best option is to always hold investments for over a year to take advantage of long-term capital gains and to avoid short-term capital gains whenever possible. Just coming from my personal experience, if I only focused on long-term capital gains and never traded at all, my portfolio would be a quarter to a third of the size it is now. But it's important to remember that there is a lot more to investing than just taxes. Let's say I'm currently holding on to two different cryptos, Crypto A and Crypto B. At the moment, I can see that Crypto A is overvalued and Crypto B is undervalued. I predict that the prices of both cryptos are going to normalize, and so what I do here is I sell some of Crypto A that I have and I use it to purchase some of Crypto B while the price is lower. I will have to pay short-term capital gains on this transaction, but if I do this right, my overall profits by the end of the year can be higher than the taxes I will have to pay. This is a lot of what I do, is I move coins around like this. I personally think the best strategy is to have a balance and use both short-term and long-term capital gains. If you like this video and want to know some more investing tips, then check out the video where I talk about dollar cost averaging and how it can help you avoid the pitfalls a lot of people fall into when they start out investing. Thank you all for watching this video, and remember, as always, keep it in the green.